Hi and welcome to this video. In this video we'll be talking about expense ratio and why it is important. See, it's important because expense ratio tells you the expense that you're paying in order to get your money managed by a fund manager. And this expense would always be there whether you're making money or not. So if you're making money, this expense is taken out of the profit that you've made. But if the fund is not making money, then even then this expense is taken out. So in case if you have this, if the fund has got negative returns, then that negative return would become even more negative because the expense would be added to it, right? So it becomes important to select funds which have low expense ratio, especially in a fixed income instrument. When you're talking about a debt fund, a bond fund, then you're talking about then you're looking at 7, 8, 9% kind of a return. And if the expense is on a higher side, then that can severely impact the performance, the overall performance of your portfolio, right? So expense ratio. Now let's go on to value research and let's look at L&T Midcap Fund. Now here the L&T Midcap Fund has an expense ratio of 2.04%. So if we check, it has performed pretty decently over the long period. Now we check the peers performance, right? L&T fund has given 12% kind of a return, 15% kind of a return, and the expense is 2.04%. Last year has not been good. It has given negative return, and whereas the peers have been able to do fairly well, they've been able to post positive returns. So last year hasn't been that great for small and mid cap funds. They've not really performed well. So here for last 1 year, this has been kind of a laggard. It has not been able to outperform, or it has not been able to perform at par with its peers. Its expense ratio is comparable, but if you look at the past performance, it has been able to outperform 3 years, 5 years. There has been an outperformance, so we can actually still give it some bit of benefit of doubt because it has given some outperformance. Now if you look at Invesco, the expense here is 2.56%. So every year this is the expense that you pay, and it has not been an outperformer. See, 3 years return is 10%, 5 years return has been 12%. So in a way it has been performing almost at par, but it has not been an outperformer, but its expense ratio is on a higher side, right? So maybe this is one fund that one can avoid. If you look at Kotak, its expense ratio is even lesser, and its performance has been comparable and has done really well. So if I have to choose one between all of these, purely looking at the expense ratio and some bit of performance, past performance, I would rather invest into Kotak emerging equity regular scheme. Now also let's look at a debt fund. Let's say a Kotak saving fund, regular saving fund. Let's look at this fund. Now this expense ratio of this fund is 0.68%, and let's compare it with the peers. So Kotak regular saving fund is 0.68. Then you have ultra short fund of Bank of India, it's 0.59, and you have SBI at 0.5. So this is the lowest, and the performance is comparable, right? So this fund actually has a lower expense ratio. So keeping other things constant, if I have to choose one, I would choose for the one which has the lower expense ratio. And of course that cannot be the only criteria, right? It should be comparable. In case if it's too high, then one should avoid, but if it's comparable, just a minor difference, then you can overlook that. Now why is it so important? Why is expense ratio so important? So let's look at it. Let's say you have invested into something which is giving you 15% kind of a return, and you have invested for a period of, let's say, 20 years. You've invested for a period of 20 years. Let me change the format. So you are invested for 20 years, and the amount that you have put in is 10 lakh. So I'll put a minus sign in front of it because this is going out of our pocket, minus 10 lakh. Now what could be the future value of this fund? If we look at future value, so the rate is 15%. We are investing for, the rate is 15% and we're investing for 20 years, and we are investing 10 lakh rupees. So what would be the future value after 20 years? It'll be this much. Let's increase the period to 25 years. So it'll be 3 crore 29 lakh 18,952. Now let's suppose there was an expense of 2% and your return is now 13%. It's not 15% because of the expense. The return is only 13%. So 3 crore 29 lakh becomes 2 crore 12 lakhs. So there is a gap of over 1 crore rupees, right? Now in case if the gap is 1%, let's say there would not be a 2% gap. That's quite unrealistic. But if the gap is closer to 1%, let's keep it at 14%. Even then, it's a gap of around 60 odd lakh rupees, right? So this becomes critical. Even if it's 0.5%, even then you're looking at 30 to 40 lakh rupees of gap here, because if you're let me just keep it okay, this is taking it as 14.95 only. If I do this, yeah, now if I keep it at 15%, this becomes almost 35 lakh rupees gap. So even that 0.5% gap can really impact your overall performance in the long term, and especially when we are investing into for long term for wealth creation. 0.5%, 1% makes a huge difference, and that's why expense ratio should always be taken into account when you're investing in a fund, right? So again, do not keep expense ratio as the sole criteria. The lowest expense ratio doesn't necessarily mean a great fund. Expense ratio should be comparable, right? So now in our next video, we'll be covering an important concept, which is the fund manager's track record, right? So let's dive in.